History gives us plenty of warnings. In the 1800s and early 1900s, bank runs were common. A rumor spreads. People line up. Banks collapse overnight. Entire towns lose their savings. The Great Depression made this painfully clear. Thousands of banks failed. Depositors learned, too late, that their money had been lent out multiple times over. The response wasn't to end fractional reserve banking. It was to protect it. Governments introduced deposit, insurance, and central banks as lenders of last resort. The message to the public was simple. Don't worry, your money is safe. But behind the scenes, a new rule emerged, one that changed everything. If banks could create money in good times, central banks would create money in bad times. This is where the system truly crossed a line. By the late 20th century, fractional reserve banking merged with fiat money currency backed by nothing but government authority. No gold anchor, no natural limit. Banks expanded credit aggressively. Debt became the fuel of growth. Homes, cars, education, everything financed, everything leveraged. And for a while it looked like magic. Till 2008. When the housing bubble burst, the truth leaked out. Banks had created massive amounts of credit based on fragile assumptions and risky bets. When loans went bad, the money vanished. Not slowly, instantly. The system froze. Interbank lending stopped. ATMs were days away from shutting down in some countries. And then came the ultimate revelation. Banks were too big to fail, not because they were good, but because the entire system depended on the illusion continuing. Governments and central banks stepped in with trillions in bailouts. Losses were socialized. Profits remained private. Fractional reserve banking survived, but only by exposing its final contradiction. If banks take risks with created money, and the public absorbs the losses, who is the system really designed to serve? You might think lessons were learned. They weren't. Instead, the system doubled down. After 2008 came zero interest rates, then quantitative easing, then emergency lending programs. Then, during crises, trillions created almost overnight. Each fix treated the symptom, not the cause. More debt to fix debt. More liquidity to fix insolvency. More confidence theater to prevent panic. And the pattern repeats. Asset prices inflate, inequality widens. Those closest to new money benefit first. Those furthest pay later through inflation and instability. Fractional reserve banking doesn't just create money, it reshapes society. It rewards leverage over saving, speculation over production, debt over discipline. Every cycle ends the same way, with a breaking point. Today, the parallels are impossible to ignore. Banks hold less reserves than ever relative to their liabilities. Derivatives markets dwarf the real economy. Government debt levels would have been considered unthinkable a generation ago. And once again, confidence is doing the heavy lifting. Not gold, not savings, not real reserves, just trust. Trust that withdrawals will be manageable. Trust that central banks will step in. Trust that the math will hold. But history tells us something uncomfortable. Fractional reserve banking doesn't eliminate crises. It schedules them. The only question is timing. So what are we left with? 3 clear takeaways. First, fractional reserve banking is not neutral. It is a design choice, one that prioritizes credit expansion over stability. Second, every major financial crisis is not an accident, but a stress test. The system eventually fails. And third, the system survives not because it's sound, but because it's protected. Protected by law, protected by central banks, protected by the belief that there is no alternative, which leads to the final uncomfortable question. If your money exists mostly as promises, if stability depends on confidence alone, if every fix requires more creation of imaginary funds, what happens when trust finally runs out? That answer hasn't been written yet. You are living inside the experiment. If this video challenged what you thought you knew about money, share it. Subscribe for deeper dives into the systems that shape your life but rarely explain themselves. Because the most powerful systems don't rule by force. They rule by being invisible. You've been told a comforting story your entire life, that banks keep your money safe, that when you deposit cash, it waits patiently for you. That the system is stable because it's built on trust, math, and regulation. Now here's the unsettling question that almost no one asks. What if your money isn't really there at all? What if the global financial system, the one that decides who gets rich, who stays in debt, and who gets wiped out in a crisis, is built on a contradiction so fundamental that it can never truly be fixed? Tonight, we're going to uncover banking's original sin, a quiet rule that sounds technical, boring, even harmless, but has fueled booms, busts, bailouts, and collapses for centuries. This is the story of fractional reserve banking, not as it's taught in textbooks, but as it actually works. And by the end, you may never look at a bank the same way again. To understand the con, we need to go back long, before skyscrapers, central banks, or credit cards. Back to a time when money was heavy, literal, and hard to fake. In medieval Europe, wealth was gold and silver, dangerous to store at home, easy to steal. So merchants began depositing their metal with goldsmiths, craftsmen who already had vaults, guards, and strong doors. The goldsmith would issue a receipt. I owe the bearer this much gold. At first, these receipts were just storage claims. One receipt, one pile of metal, no tricks. But then something interesting happened. Goldsmiths noticed that depositors almost never came all at once to withdraw their gold. Most people only needed a portion at any given time. The rest just sat there. That idle gold was tempting, so the goldsmiths committed the first quiet sin. They began issuing more receipts than gold they actually held. Not all at once. Slowly, carefully, just enough that no one would notice. If 10 people deposited gold, and only one ever withdrew at a time, why not lend out some of the rest? After all, the receipts still circulated as money. People trusted them. And just like that, money was created out of thin air. No announcement, no vote, no public debate. It's only one condition. As long as everyone didn't ask for their gold back at the same time, the illusion would hold. That was the birth of fractional reserve banking. Fast forward a few centuries, goldsmiths evolve into banks. Receipts evolve into banknotes and deposits. Governments notice the power of this system and decide not to shut it down but to formalize it. Banks are now legally allowed to keep only a fraction of deposits as reserves while lending out the rest, 10%, 5%, sometimes less. Here's the key point most people never fully grasp. When a bank lends money, it does not lend existing money. It creates new money by typing numbers into an account. Your deposit becomes someone else's loan. That loan becomes another deposit. A deposit becomes another loan. One original dollar turns into many dollars on paper. This is called the money multiplier. And it's not a bug. It's the engine. But engines can overheat, because this system depends on one fragile assumption, that not everyone will demand their money at once. The moment confidence breaks, the system breaks with it.